Hello, everyone, and welcome to today's teleconference entitled How to Triple Your Money for Long-Term Care Immediately. Immediately is the key word there, so we'll get into that. I want to welcome all the Eagle subscribers and also the estate planning specialist customers to today's call. I'm Roger Michalski, publisher of Eagle Financial Publications, and I have the pleasure of being the publisher of Bob, David, and Todd, who are all on today's call. We got Bob Carlson from Retirement Watch, and we have David Phillips and Todd Phillips from Generational Wealth Strategies. And welcome to the beginning of November, which happens to be Long-Term Care Awareness Month. So perfect timing to have some information about planning for your long-term care. It's something not everybody does, and we have this great way to do it. That's what we'll be talking about today. So I want to welcome the guys to today's call, and we're going to jump right into a poll question. And for those of you who have never been on one of these calls before, let me explain how the poll question works. I'm going to ask a question. This one's going to have 4 answers, and you're simply just on your phone, just going to touch 1, 2, 3, or 4, whichever one you think the answer is. We'll compile that up, and then we'll get feedback from the guys. So the question is, what is the probability that you or your spouse will need long-term care? Press 1 if you think it's under 25%. Press 2 if you think it's between 26 and 50%. Press 3 if you think it's between 51 and 75%. Or press 4 if you think it's over 75%. So again, what is the probability you or your spouse will need long-term care? Press 1 for under 25%, 2 for 26 to 50%, 3 for 51 to 75%, or press 4 for over 75%. So everybody's casting their vote. Let me give you an overview of what we'll talk about today. We're going to discuss how many people need long-term care, what the average costs per month are, and how long the average person will need it. We will discuss what most people do wrong when it comes to planning for long-term care and the impact giving care is on family members. And perhaps most importantly, we're going to discuss a solution to long-term care that not only triples your money when used for long-term care, but it also grows your initial investment. So it's good either way. And we'll have several Q&A sessions throughout the call where you can directly ask Bob, Dave, or Todd a question. So if you'd like to be live on the air and ask them a question, hit *3 to get into the queue. One of our colleagues will get where you're from and get your question and get you right back on the call. So again, if you'd like to ask them a question, hit *3 to get into the queue. Just keep in mind that we cannot give personalized advice. All right, so let's see the poll question results here. Again, what was the probability that you or your spouse will need long-term care? And 39% say it's between 51 and 75%. 31% of you thought it was between 26 and 50%. 17% said it's over 75% chance, and only 13% said it's an under 25% chance. So, Bob, you have some really interesting stats on long-term care, so give it to us.
Sure. Thanks for having me on here, Roger. I'm looking forward to this. Let me first get to talk about what is long-term care. There's a lot of misunderstanding about what long-term care is, and that's why the answers to this question vary a lot. Long-term care is defined as needing assistance with at least 2 of the activities of daily living. There's six activities of daily living, and these are dressing, bathing, eating, talking, using the bathroom, and what they call transferring or mobility. Long-term care is also defined as being cognitively impaired. So any of those items if you need any of that, you'd be needing long-term care. Now, long-term care often is considered to be nursing home care, and that used to be the case. It's not the case now. It encompasses much more things, much more activities. Long-term care could be daycare, assisted living, memory care, A significant portion of long-term care now is delivered at home, not at any kind of facility or other type of residential. So the share of at-home long-term care is increasing. Most of it's still in assisted living facilities, but the at-home care portion is increasing. And long-term care can be paid help, or it could be unpaid family members. And technology and other developments make having long-term care at home more practical than it used to be. So all that's background to make sure we understand what long-term care is. Another thing to notice is the definition doesn't include how long you need long-term care, even though it's called long-term care. If you need help with any of these activities of daily living for any period of time, that's considered long-term care. And a number of people need long-term care for only a few days or weeks. We'll get into that in a little bit. So let's get down to the statistics now. The overall probability of someone turning 65 today needing long-term care at some point during the rest of their life is about 70%. And that's
so everybody was right on. The number one, the most popular answer was 51 to 75%. So we got some good, smart people out there.
That's right, and that's data from the U.S. Department of Health and Human Services. But let's break that down a little more. Women are more likely to need long-term care than men. That's because women tend to live longer. So about 79% of women are likely to need long-term care, whereas 58% of men are likely to need it. And the interesting data is, I mentioned you can receive long-term care in a number of different places, and about 80% of long-term care is received at home with unpaid assistance from a family member. So that's the basic data, and you can see our subscribers are pretty well aware of what long-term care is and how they're likely to need it. And so we'll get moving on with the rest of the presentation.
All right, so let me loop Dave in here. And so, Dave, what do most people do wrong when they're planning for long-term care?
Well, good. First of all, it's good to be here, and Bob, good to hear you and Roger together, and Todd, I know you're here with us as well. The thing that most people do is they assume that the government is going to take care of them. That if they can't do 2 of the 6 activities or start losing their memory, that the government's going to step in and they're going to offer funds to take care of them. And while that can be the case for the first 100 days, after 100 days, Medicare is gone. And in fact, I've actually seen this happen in my own family, where my brother-in-law experienced that, or my sister-in-law, because my brother-in-law was in a facility, and they actually kicked him out, sent him home, and said, "You're done." And so the government was no longer willing to take care of him. Then they think, well, of course, then Medicaid will pick up and take care of it for me. Well, Medicaid does not take care of you unless you have totally spent down your assets. And I certainly hope that people that are listening to us today on this call that are our clients or subscribers to Bob's or my newsletter are not in a situation where they're willing to spend their assets down to 0 to qualify for Medicaid. And if you do qualify for Medicaid, then you get assigned a facility instead of choosing a facility or even choosing to stay home. The other thing that I think, and I'll just get off real quick on this, but the other thing that people plan incorrectly is they think, well, if this ever happens to me, my husband will take care of me, my wife will take care of me, my children will take care of me. And well, that I think used to be the case maybe 50 years ago or so. It's not the case anymore. People have lives to live, and they move on, and they, even though they're well-meaning and they want to take care of mother, they also know that there are facilities that can do the same. I just recently had a client tell me that her husband had early onset Alzheimer's early. Nobody in the family is able to take care of him, so she had to put him in an assisted living facility with or memory facility with full time, because there was no one really, and he was only early onset. So things are changing. The generations are changing, and we really have to prepare for the possibility. The nice thing about it is the solutions are so easy to adapt to today. It's not as difficult as it was, and it certainly isn't a use it or lose it proposition. We'll get into that later, but that's the biggest mistake, I think, those two things.
All right. Bob, do you have anything else to add to that?
Yeah, an important point that most people get lost on is that long-term care is not medical care or health care, so it's not covered by any of these government programs that cover health care and medical care, even by your private insurance policy. So that's why it's not covered by these other sources. And also, even if your loved ones are available to help you, they might not be, qualified to help you. People now, when they need long-term care, they also often need some kind of, special assistance or some kind of medication that has to be given in a certain way and things like that. So even if you have family members who are interested in helping you, they might not be qualified to do it.
Yeah, very good points. Very good points, and that's why it's so important to plan for it. And we're going to be giving you some solutions here in just a minute. But first, I want to remind everybody.
Hey, Roger, can I just add one thing to that too?
Sure.
When we start using family members to help us, we then require that they totally change their life. And we've all seen this happen, not only in our own family lives, but I've seen it happen a couple of times in my situation. So, you're asking people to totally change, their social schedule, their, and then of course the economics. They have to maybe not work as much, do things that they were doing. So it requires a lot for family members to take care of us, for sure.
Yep, absolutely. Well, I want to remind everybody, if you want to ask these guys a question, hit *3 to get into our queue, and our colleagues will get your question and where you're from, and we'll get you right back on the call. And we're going to be doing Q&A here in just a minute, so hit *3 now to ask these guys a question. Let's go to the second poll question. This one also has 4 answers, and the question is, how much are the average long-term care costs per month? So press 1 if you think it's less than $2,500. Press 2 if you think it's between $2,500 and just under $10,000, $9,999. Press 3 if you think it's between $10,000 and $15,000, or press 4 if you think it's over $15,000. So again, how much are the average long-term care costs per month? Press 1 for less than $2,500. Press 2 for $2,500 to $10,000. Press 3 for $10,000 to $15,000. Or press 4 for $15,000 or more. So we'll get back to that poll question here in a few minutes, but let's go to some questions. We're going to go to one of the write-in ones. So the question is, buying long-term care insurance is very expensive to buy. What happens to your money paying for long-term care if you suddenly pass away and are unable to use the insurance?
Why don't we let Todd answer that question?
Do you want me to answer that now or wait until?
All right. Yep. Well, we just answered the question, asked the question. So yep. Let's answer that right now.
Yeah. So we're going to be talking about asset-based care plans. So the funds we're putting in is from another asset, and whatever is left that we don't use for care remains with our family, and they get the death benefit. So yeah, whatever we don't use will still be left for the family.
And with a traditional long-term care insurance policy, not one of these asset-based policies, you pay your premiums every year, but if you die without ever needing long-term care, you don't really get anything for the premiums other than the peace of mind of knowing that the policy was there if you needed it. There's nothing left for your heirs, your beneficiaries.
Correct. Yeah, it's kind of we used to call that the use it or lose it propositions, and those are pretty well over. With long-term care, that ship has sailed. We're now into this asset protection programs, and there's several options for them to choose. So, and Todd will be covering those a little bit later.
All right, let's take another question that's not long-term care related, but estate planning. This is Murphy from Louisiana, and Murphy asks, irrevocable trusts, what are the pros and the cons?
Well, Bob, you want to take a whack at that first, or I can handle it. I can certainly handle it.
So I'm giving you good doozies. I'm not giving you softballs here.
Irrevocable trust has a lot of benefits to it. If you're a very wealthy person, the assets in it are not in your estate for tax purposes. Also, the assets in the trust avoid probate, and they're also available to your beneficiaries who you named in the trust. And because it's irrevocable, it's sheltered from your creditors. The trustee manages the assets and distributes them according to whatever terms you put in the trust. So there are a number of benefits to it. It depends on what your goals are, what you're looking for. But irrevocable trusts are becoming more and more popular each year because people want to provide for loved ones, but they're concerned that perhaps the loved ones won't handle the assets well or won't invest them well. So they put them into these trusts. So the trustee handles a lot of the financial aspects of it, and the beneficiaries just get the benefit of having that money available.
Yeah, and let me just add, a lot of irrevocable trusts are set up, to hold insurance policies that create a leveraged asset. You put in $1, you create $4, $5, $6, $10, depending on your age, for later delivery. And all of those new dollars, those big dollars, those amplified dollars, are tax-free. So you see a lot of that. But just remember, a revocable trust is tax neutral. An irrevocable trust has serious and usually beneficial tax implications. So you just have to make sure that you can get the asset into an irrevocable trust and transfer it. Nice to transfer assets when they are in low value and have high appreciation opportunities. That's kind of the best asset to transfer in an irrevocable trust, such as life insurance.
All right, yeah, some good overview there, guys. Let's go to Laura from New York. Laura, you're live on the air. What's your question?
Hi. It's kind of jumping ahead of what we're talking about, but I'm wondering if there are any state benefits for funerals. My brother's going to be stuck, either, giving me cremation or a burial. And so that was my first question. And my second question was, I was wondering if anyone here could actually represent a memory aid that they have found successful.
Boy, that's I can. Yeah, go ahead, Bob.
Yeah, I was going to say most states do not provide for any kind of funeral expenses. Social Security, in some cases, not in all cases, but provides $250, which is not going to cover much. but generally these type of expenses are not covered by any kind of government program I'm aware of.
No, and memory there's several memory pills you can that people are hawking online that you just have to kind of be careful of, and but I use one and I like it, so it works for me and my family. But
are you allowed to say what it is?
Well, maybe offline. How's that?
Okay.
Okay. Well, thanks, Lord. We got your number.
Sure.
So we'll have Dave get in touch with you. All right. Thanks for the question. Good question. All right. Let's do one more write-in for right now. Then we'll go back to some more Q&A here in a few minutes. This one is from James from Nevada, and I'm going to have Bob answer this one. James asks, if I wait until 70 to collect Social Security, when I die, will my wife get the 24% higher payment I received for waiting, or only the FRA benefit I was entitled to?
Yeah, good question. When there's a married couple and one spouse passes away, the surviving spouse receives whatever the higher of the two benefits the couple was receiving. So if you wait till age 70 to take your Social Security and you pass away first, then you've essentially maximized the amount your surviving spouse is going to get, because he or she will get the same amount you were receiving.
All right. I knew Bob would have a good answer for that. All right. Well, we'll take some more Q&A here in a few minutes, but let's go back to the last poll question. And the poll question was, how much are the average long-term care costs per month? 49% of the people said it's between $2,500 and $10,000 a month. 41% said it's between $10,000 and $15,000. 8% said it's $15,000 or more, and only 2% said it's less than $2,500. So I'm going to have Dave give us some stats about some long-term costs.
Yeah, well, it kind of depends on what kind of care that you decide upon. If you're going to stay in a private room and you're not going to share, a room with someone else, on average, the average cost is around I'll round it up to $11,000 a month. So that would be in your number 3 category there. Your number 3 is your answer. So what was number 3 percentage?
I think it was
answer?
49%. Yeah, said that.
So that's about right then. People are pretty well spot on with that they understand that's about the average cost. Now, you can do less than that, of course, and you can share a room for $9,000 a month. And you can just go to an assisted living, which is about $6,000 a month. And these are the U.S. Numbers as of 2024. So that's across the country. Now you have to remember though that in specific states it could be significantly higher and a little bit lower. It's not going to be much lower, but in states like Alaska and California, New York, you're going to see the cost going to be a lot higher for care outside the home. Now, care inside the home is a lot different, because inside the home you may need care 24 hours a day and 7 days a week, or you may need it just hourly. So you can pay by the hour for care, and in those cases, it's usually around $40 average U.S., about $40 an hour for somebody to come into your home and take care of you for a couple of hours. So some of those things, can be spread out just depending on the type of service that you would need. Like in that situation, the example that I gave, where the spouse now has early onset Alzheimer's. So in other words, he can take care of himself a large degree. He's in a memory facility, and it's well over $20,000 a month for them, for her. So.
Yeah, regardless of the bottom line is regardless of which path you take, it's expensive. It's expensive, and you definitely have to plan for that. So we're gonna get into that here in just a second.
And it can eat away your assets, your estate, leave less for your spouse, of course, and leave little or nothing for your family. And if that's your goal, then you accomplished it. But if it's not your goal, you need to prepare for it. So.
Yep, absolutely. Sorry. Next poll question. This one also has 4 answers. The question is, how long does the average person need long-term care? So press 1 if you think it's less than a year. Press 2 for 1 to 3 years. Press 3 for 3 to 5 years. Or press 4 for more than 5 years. So again, how long does the average person need long-term care? Press 1 for less than a year. 2 for 1 to 3 years. 3 for 3 to 5 years. And 4 for more than 5 years. So we'll get back to that answer and find out the answers to that poll question here soon, and we'll be doing some more Q&A in a minute. But first, let me loop Todd in here. He's our expert in annuities and long-term care solutions. So we talked about how most people will need long-term care. We talked about how most people don't plan for it properly, and they don't realize the best ways to plan for it. So Todd is here with a solution. So Todd, tell us about this.
All right. So I'll kind of give a little background on asset-based care plans, which I had brought up earlier. So when we say asset-based care, we're using an asset, and it's either in the form of an annuity, a deferred annuity, or a life insurance policy. And it will leverage what we put in for our future care. That's the essence of asset-based care. But I'm going to go on some background. So they really came into vogue, became popular due to the passing of the Pension Protection Act in 2006. President Bush passed it, and so it became law and effective in 2010. So back in 2010, we had a lot of companies coming in, introducing, and trying to take advantage of this new law. So it's actually tax code 844 LTC and tax code 7706, and that allows you to be able to take what the Pension Protection Act said is that you can take money from a tax-deferred annuity or life insurance and take it out tax-free if it's used for long-term care. So, for example, somebody has a $20,000 basis on an annuity, a deferred annuity, and it's grown now to $100,000. They can take that gain and use it for long-term care tax-free. That's what the Pension Protection Act gave us. So then what we have is these asset-based or leveraged care solutions is what we call them, and it's going to give us 3 times what we put in for care. So if we had, in that example where I said $20,000 grew to $100,000, and we then exchange that 1035 exchange that annuity for a long-term care annuity, it has to be PPA compliant. Well, it'll give us $300,000 or 3 times for our future long-term care, and that can be given on a single basis or a joint. So we could exchange cash value from a life insurance policy for a long-term care annuity. We could also do it in another life insurance policy with long-term care. So there's several ways that we can do it. But the bottom line is we're taking that asset and we're able to use it for our future long-term care. If we don't end up using it for our long-term care, we still have the asset. So I'll give you an example of one of them that I was first talking about in the annuity chassis. We have one right now that is paying an interest rate of 6%. Now, the cost to have that extra care will range from 50 basis points to 3% depending on your age. The top age on that is going to be 80. So the 80-year-olds would have the highest cost, which is 3%. So let's just take the 80-year-old example, and we'll say that they are an 80-year-old couple is they've got $100,000, and they're getting the asset-based care annuity, it's going to give them $300,000 of long-term care, and they're going to earn an interest rate of 6%. Now their cost for the care is going to be 3%. So that annuity is going to be growing deferred. It's not a payout annuity, it's a deferred annuity, and it stays deferred forever until we take the long-term care. So it's going to work similarly to a CD or a money market, and it's just going to grow. But it's going to grow at 6%, but have the cost of 3% coming out. So it's going to net about 3% gain each year. So if they are lucky and they don't need the long-term care, and we'll just say that they live 10 more years, we have the net of 3%. They're going to, that 100,000 is going to grow to 130, and they're going to pass that 130,000 to their beneficiaries. However, if they do need care, go ahead.
No, go ahead. Yeah, you got it.
If they do need long-term care, they're going to have that 330,000, the 3 times available for their use of care, and either one can use what is needed, and they're gonna pull it out as needed, whoever needs it. So that's one example, and that works great. So it works for couples. We can do it if now there is some health qualifying. I would say though, definitely these asset-based care plans are easier to qualify for than the traditional care. They were much difficult. You can still get traditional care today, and it's a lot more difficult. You have to be almost gem mint condition, perfect. But these you can have, some things going wrong. But really, I'd say the big knockouts I see is if you have a heart problem with diabetes, is usually pretty tough. I do have some plans. We do have plans that we can get. You obviously can't have Alzheimer's already or already be needing assistance with the activities of daily living. And the appropriate plan for you is going to a lot be based on your age. I would say generally the life insurance versions are better if you're 70 and younger, and the annuities tend to be better if you're over 70. That's a gross generalization, though. The qualifying is different per company, and we will factor in all of these. We've been working on these since 2009, and Bob's been recommending them, his readers, to us since 2012. Bob's written some fantastic articles recommending his subscribers for these plans, these exact plans, since 2012, and we get more letters of thanks for these from other family members because their parents, had the wherewithal to take advantage of these plans 10, 15 years ago. And any more questions on that?
All right. Well, I want to mention that. So if you would like to find out more information about this, we set up a website that you can go to and fill out a little form, and Todd and his staff will get in touch with you and go through all the details. And like Todd said and David said, everybody's situation's a little bit different, so they'll get you. This is a great one to have. It may or may not be the actual right one for you, but they'll help walk you through this. But this is a great example where you can triple the money that when you use it for long-term care, and you're getting the 6% gain in the meantime. So it's growing still, and it can triple if you actually use it for long-term care. So go to this website. It's ropltc.com. So that's R as in Roger, O as in Orange, P as in Paul, L as in Larry, T as in Tom, C as in Cat. It stands for Return on Premium Long-Term Care. So go to www.ropltc.com, fill out the form, and Todd and his staff will get back to you and get you into the one that's perfect for you. And when we were talking, the four of us were talking about this, and I was like, we got to do a teleconference on this and get the word out, because I was very excited about it, because I know that this is we talked about how people don't plan for this, and it is confusing, and so when people think of it, they're going to be covered by Medicare when they're not, or their insurance, and they're not, and we want you to be prepared. So this is the best way, I know to do it. So again, go to www.ropltc.com and fill out the form, and they'll be in contact and set up a time to talk with you and walk you through the best solution for you. So that's terrific, and I'm excited about that. So let's go back to the last poll question and see what we have here. So this is, how long does the average person need long-term care? 46% of you said it'll be 1 to 3 years. 37% said it'd be 3 to 5 years. 13% said it'd be over 5 years, and only 4% said it'd be under a year. So most people think it's going to be a while. And again, it costs so much. This is why you need to prepare for it. But Bob, give us the stats on how long people need long-term care.
Yeah, this is the important question because people want to know kind of what their maximum potential liability is for long-term care. And the data, and these are people who need any kind of long-term care, not for the general population, but if you need long-term care, about 20% will need it for 5 years or longer. 50% will need it for 1 year or longer. And another 20% will need it less than 1 year. So it's a pretty wide fluctuation. And another way you can look at it is the average need for long-term care is about 3 years. So if you need long-term care, odds are it's going to be lasting you about 3 years. If you're a woman, it's actually a little longer. It's 3.7 years on average. Well, for men, it's only 2.2 years when they need long-term care. And the 20% of those who need it for more than 5 years, they tend to have one of these long-term chronic conditions such as dementia, Parkinson's disease, or they had a stroke. So these are your potential liabilities. And so that's what you want to plan for. Is most people, they can plan for 1 year or less. They have enough assets to do that. But it's those people who need the longer than 1 year, and that's about 80% of those who need long-term care at some point are going to be in there for more than a year, whether it's an assisted living or at-home care or anything else. So those are the numbers you're looking at, and that's what you want to be planning for.
Yeah, I just did some quick math. You had mentioned, David mentioned earlier, it's pretty much between $6,000 and $10,000 a month is what you can assume, and there's a big range as he talked about. But let's just take the 10,000. The average person you just said is 3 years. That's $360,000. Mm-hmm. That's a lot of money for anybody.
Another thing to keep in mind is that long-term care costs are rising faster than general consumer price inflation. So when you're looking at today's costs, consider it's going to be rising pretty much every year and compounding.
Yeah, and the nice thing about the new solutions, these leveraged care solutions or asset-based care that Todd was talking about, is that in the case of the annuity, as the annuity grows in value, well, so does the 3 times benefit. So, if it grows from 100,000 to 200, well, now your benefit goes from 300 to 600,000 because it's 2 times. So you just have to remember that's part of it. And then some of the other plans, like the traditional return of premium, they have inflation riders that you can add to it to include in your plan, and that gives you an option to keep pace with inflation if that's where you want to go. So there are some really good options out there in this asset protection world that Todd was talking about. Todd, I don't want to miss your opportunity to talk about, from your right hand to your left hand, right pocket to your left pocket concept. I think that's just a valid concept, and you do such a good job with that.
Yeah, well, I mean, it's an asset, right? So it still remains an asset. It's like transferring from your left pocket to your right. If you have $100 and you put the $100 in your right pocket, it's still going to be the $100, and that's how this works. The money is still there. It's still an asset on your balance sheet. It's still, you could liquidate it if you wanted. It's not like traditional long-term care where it's a use it or lose it and you no longer have any funds there. This, you still have it, and it's actually growing. I like to think of it as a CD. Most people understand CDs, but CDs earning 3% or 4%, that's what this is making, but it's also going to have that 3x or 4x leverage for care, depending on how old you are and what risk class we can qualify you for. So you always have that asset. If you wanted to liquidate it, maybe 10 years from now, we're not even using dollars and we're going to some new currency. You could liquidate it, cash it out, and go buy that or do whatever else you need. So it's nice to have that asset continue to grow.
Yeah, so everybody write this down or go right on your computer right now and go to www.ropltc.com. That stands again for Return of Premium Long-Term Care. So again, www.ropltc.com, and just fill out the short form on there, and Todd and his team will get back to you, and again, get you all the details you need and answer your questions, and hopefully then get you signed up so you are prepared for long-term care, because most people are not. So we want everybody to be prepared for this. So again, go to www.ropltc.com right now to get more information. All right, let's do some Q&A. Let's go to George in Massachusetts. George, you're live on the air. What's your question?
My question was, could the annuity that is being talked about, proceeds, be applied as essentially short-term care insurance to cover the elimination period on a pre-existing use or lose long-term care insurance policy?
So you're wanting, you could take, maybe see if I understand this right, you could take another annuity and use it to pay for long-term care. You would have to prove that it went to pay for the long-term care policy that you had, and say that those withdrawals were used for long-term care. Now, it's not going to have the leverage like these plans that we were talking about, but you could use, it could be Pension Protection Act compliant, but you'd have to prove that those proceeds were going straight to pay for long-term care.
Thank you.
Did I answer that right? Yeah, okay.
Yep.
Yeah.
Okay, all right. Thank you, George. All right, let's go to William in Virginia, and I'm actually calling from Virginia. So, William, you're live on the air. What's your question? William from Virginia, are you there?
I'm sorry, yes.
Yeah, so what's your question for the guys?
My question is, who determines when someone cannot do 2 of the 6 daily living tasks? Does it need to be a physician or a special physician, or I don't imagine you can just say yourself or your family that you can no longer do those things? How do you qualify to start receiving the benefits of your long-term care plan?
Todd, you want me to take that one?
You can, or I can. Either way.
Yeah. Well, I'll just take a whack at it. Of course, it depends on the kind of plan that you set up ahead of time. But typically, it just has to be a qualified caregiver, so a nurse, a physician, and you're going to be you if you can't do 2 of the 6 activities of daily living, or even if you're cognitively impaired, you will have seen a physician, and they will verify that fact. And so it can't just be a family member and say, well, he can't do this, but go to a physician or have these companies actually remember you're putting your money in, you're receiving an increase of that benefit for care if you need it. If you don't need it, your family gets the money back, and plus interest if you're doing like the annuity, and so it's kind of key that the insurance company has this money for this period of time where they can actually make money on it. So they're not in a losing proposition here. They're actually and this works for them, but they definitely do pay out claims. And Todd and I and my staff can tell you seriously, because we do estate planning. That's our focus, is estate planning. Generational Wealth Strategies, our newsletter, is about estate planning. We have been doing estate planning for 50 years. Long-term care is a part of that. It's just part of the total process of estate planning, and it's determining who gets what, when they get it, how they get it. Well, in the case of if I can't do these activities of daily living, you just get someone that's certified that can say he can't, and then they'll certainly pay out. So we have like Todd says, we have so many good letters from people saying thank you. So
reach out to if you can't. I tell our clients that if you can't do 2 of the 6, first reach out to me, and then I'll connect you with the insurance company, and they usually assign you a care concierge person to help you start your claim. There are elimination periods that can range from 0 days to usually 90 days, where you start your claim and you can't do the 2 of the 6, and then they start. Now, some will actually retro your benefits from the start, even though you waited 90 days. They'll back in and start you from 3 days before. So it does depend on the plan. But, in pretty much all cases, we will need some kind of licensed practitioner to sign off. And they're going to be familiar with this because the 2 out of the 6 is almost all care plans, traditional or these types, use that as a criteria. It's cognitive impairment or can't do 2 of the 6.
All right. Thank you so much for that question, William. And I'm not going to put this person live on the air, but I just wanted to thank Michael from South Carolina. He hit *3 to ask a question, and he actually just had a statement. He just said, "You guys are doing an amazing job explaining all of this. Great job." So I second that, Michael. And of course, at Eagle, I always strive to bring in the best. When I started Eagle, it was all just stock stuff, and then customers started asking about retirement issues and things like that. So I went out and found the best. I turn down people all the time, quite honestly, of oh, Roger, I want to be, can you publish me? No. But went out and got Bob and Dave and Todd and so I really appreciate that input, because I do look for the best always, and we definitely have them. As you can tell from these answers, these guys know these things inside and out. So to get your long-term care plan together, again, go to our website that we just set up for this, www.ropltc.com. Again, that's Roger, Offer, Paul, Larry, Tom, Katz. ropltc.com, and fill out that short information, and Todd and his team will get back to you and again go through your specific requirements and what you need and make sure you're getting the best one. So several people, and you mentioned this, Todd, briefly, but lots of questions on the right ends. And I'll just take Wandels from Alaska. I don't know if I pronounced the name right, but he said, "Thanks for all the great advice from Bob and Todd. can they comment on when is, quote, too old for access to leveraging the long-term care strategy products?
Yeah. So unfortunately, 80 is the max age for pretty much all the plans. I have several up to 80, or we have several up to age 80. We did have some up to 85 before COVID, and they pulled it off the shelf during COVID and never brought it back. So we have other solutions if you're over 80, but not going to be giving the leverage quite like the under 80 and under can. It'd be more like a bonus annuity or something like that for over 80.
Yeah. So again, if you're 80 or above and still want to explore the other options, again, go to www.ropltc.com and they'll walk you through that too. Another question: is the long-term care insurance transferable to your spouse if unable to use it due to sudden death?
Okay, so I can answer that. So it also depends. There's several types that we could do. So let's say we had the joint one, and then yes, definitely the benefits would transfer to the surviving spouse if we had them as the joint insured when we started. If we just had a single to start, and let's say the husband died and the wife was just a beneficiary, the spouse would get the remaining funds, but not the leveraged care. So they would get the remaining asset funds, or the annuities value, but not the leveraged funds. So that if you think you are wanting to jointly receive the benefits, then you're going to want both spouses to qualify coming in.
All right, let's take another live question. Let's go to, and forgive me if I mispronounce this, sorry, but Sunil from Massachusetts. You are live on the air. What's your question?
Hi. If most of our assets are in retirement accounts, can the deferred annuity you're describing be used in an IRA?
I can take that one too. So yes and no. So we can't fund them directly with the IRA money. There has to be some vehicle in the intermediary to transfer to, because these funds are able to be taken out tax-free. So the IRS is not going to let us fund with IRA qualified never tax money and then be able to take out tax-free. So what you can do is maybe fund it over a 5-year or 10-year period to lessen the burden, the tax burden, by doing it all at once. And I will say most of the annuity versions are single premium only, but there are definitely the life insurance versions are able to be funded over 5 or 10 years. I would like to see some point then allow the annuities to be funded. They just haven't done that. So we typically for IRA transfers are putting them in the life insurance chassis, and they have terrific leverage too, and also have the inflation. That's a really good point, though. I do get that a lot, and we do use that for our planning, showing how we would use an IRA to fund. There are some products that do go directly, but it makes it look like it's directly, but there is an intermediary where they are exchanging for some kind of an annuity or fixed account to transfer into the policy.
And I think the thing that you have to remember about IRAs is that that an IRA is all qualified money. As Todd said, it's never been taxed, and so but there is a day of reckoning at some point. And now we know at 73, and age 73, you have what's called required distributions. So I always emphasize to our clients that instead of thinking about minimum distribution, you should actually think about maximum distribution. Get the money out of that account and use that and leverage that, and this is what this is for, and use it for, and sure, and with the tax, our tax brackets right now currently the lowest they've been. certainly 8 consecutive years in a row ever in the history of our tax code. Right now, now's the time to be doing these exchanges and taking some of that IRA money and getting it out of there, because an IRA is simply an IOU to the IRS. And so you have the ability now to take that money and leverage it and create this benefit that will take care of you and get this long-term care thing off the things to do list. Get it off and just take care of it. And these plans today are so amazing and so awesome. I look back on where we started with this when I bought my mom and dad their long-term care policy back in the mid-'80s, and how crummy those policies were. But it was all that was available. We've got Rolls Royces running around here. These are really, really quality type plans.
I would say also we are near 20-year highs for interest rates, and that's across the board for the life insurance and the annuities. So we one benefit. Maybe it doesn't benefit if you're trying to buy a house, but these interest rates where they are today are really great for these asset-based care plans, because we're getting much higher interest than we were before.
Yeah, and with interest rates going down, I'm sure those will go down now. So I'm going to be a Nike commercial here and say, just do it. Just do it. As Dave just said, don't postpone. Now's the time to do it. And we often as humans, oh, yeah, I'll get to that. Yeah, I'll get to that. Well, do it now. This is the best time to do it. So write this URL down on a piece of paper so you don't forget it, or type it in and start filling out the form right now on your computer. Go to www.ropltc.com. It's called Return on Premium Long-Term Care. So ropltc.com. Fill that out, and there's no obligation. It's just to get you more information and find out what will be best for your situation. So Todd and his team will get with you and take great care of you. So we're right at the end here. So I'll ask Bob. Bob, do you have any final words for everybody?
Yeah, the important thing is for people to really look at the information about long-term care and not be afraid of it. There was a survey a few years ago that said people would rather go to the dentist and talk to someone about long-term care. Don't be afraid about it. Talk to people who know what they're doing. Get an idea of what's available to help you pay for your long-term care if you need it. And then you'll have that taken care of. It'll be peace of mind for you, and you'll know you won't be depending on your family to try to take care of you. Take care of yourself.
Yeah. The peace of mind is worth it right there. And with this new, this program that Todd has, you can triple your money if you use it for long-term care. And in the meantime, it's growing as well. So it's having your cake and eat it too. So I want to thank everybody for being on the call today. Thank you, Bob, Todd, and Dave, for spending the time with our subscribers and your customers here on the call today. Really appreciate it. Got some really good feedback on the thank yous, and this is great information. And so again, just do it. Go to the website right now, ropltc.com, return of premium long-term care.com, ropltc.com, and fill out that form today. So again, thank you for being on the call today. Thanks to the guys for all their great insight, and I wish everyone a great day. Thank you.
Thank you.